3 Fed officials wanted a rate hike. 6 did not. And when the full discussion is released, gold traders may try to turn every sentence into one simple answer, up or down. That is exactly where a weak plan begins. The next FOMC minutes are not a new interest rate decision. They are a delayed record of the July meeting, when the Federal Reserve kept its target range at 3.5 to 3.75%. The vote was 9-3, and the 3 dissenters preferred a quarter-point increase. That disagreement matters, but it does not tell you what gold must do next. In this video, we will build a 3-scenario plan for XAUUSD, a more hawkish interpretation, a less hawkish interpretation, and a mixed reaction that can produce a trap. The objective is not to predict the winning branch. It is to know what evidence belongs in each branch, where the idea becomes invalid, and when no trade is the strongest decision. First, understand what the minutes can and cannot tell you. The policy statement gives the decision. The minutes add detail about the discussion behind that decision, how participants described inflation, employment, growth, financial conditions, and the balance of risks. Traders read that language to estimate how broad or narrow a policy view may have been. But the document describes a meeting that already happened. Since then, markets have received new data, new headlines, and new positioning. So a sentence can sound important and still create only a brief reaction if traders already expected it. Think of the minutes as security camera footage from an earlier meeting. The footage can reveal who hesitated, who pushed harder, and where disagreement appeared. It can improve your understanding of the room, but it is not a live camera showing what every participant believes today. That distinction prevents the first mistake, treating one strong phrase as a direct trading command. Before building the 3 scenarios, create a simple control panel. You need 5 things. 1. The US dollar. 2. Treasury yields. 3. The structure of gold itself. 4. Execution conditions, including spread and possible slippage. 5. The price condition that invalidates your idea. The dollar and yields often help explain pressure on gold, but the relationship is not a machine. Gold can also respond to risk sentiment, positioning, liquidity, and expectations that were formed before the release. Use related markets as context, not as automatic buttons. Now mark one meaningful zone on the gold chart. It could be a recent consolidation boundary, a prior swing area, or another level your method already defines. Do not add 10 lines. The purpose is to observe whether price moves through an area and stays there, or moves through it and immediately returns. Finally, decide your maximum risk before the event, not after the candle becomes exciting. Before. Now we can build scenario 1. The minutes are interpreted as more hawkish than expected. This branch could appear if the discussion shows wider concern about inflation, stronger support for tighter policy, or less confidence that price pressures are moving toward the Fed's goal. The important phrase is than expected. A hawkish sentence alone is not enough if the market was already positioned for it. What evidence would make this branch coherent? You might see the dollar strengthen, Treasury yields rise, and gold move below your chosen area. Then ask the question that separates a reaction from a plan. Does gold remain below that area after the first impulse? Or does it quickly reclaim it? If related markets fail to confirm, spread remains abnormal, or gold immediately returns through the level, the branch loses quality. That is not a reason to trade in the opposite direction. It is a reason to admit that the evidence is incomplete. Scenario 2 is a less hawkish interpretation. This does not require the minutes to promise a rate cut. The reaction could develop if the discussion shows limited support for tighter policy, greater concern about growth or employment, or less urgency than traders had priced in. In that branch, the dollar may weaken, yields may fall, and gold may move above the selected area. Again, the first move is only the opening observation. Does price hold above the area? Do the dollar and yields continue to support the interpretation? Has execution started to normalize? A trader who answers those questions is not predicting certainty. The trader is testing whether the market is behaving in a way that matches the prepared branch. The third scenario is often the most useful: mixed language, mixed markets, and a possible whipsaw. Imagine that the minutes show real inflation concern, but also meaningful concern about growth. The dollar jumps, then fades. Yields move higher while gold refuses to break its range. The first candle looks decisive, the second erases it, and the third pulls traders back in. This is not meaningless noise. Disagreement is information. It tells you the market has not accepted one interpretation. Your mixed scenario needs explicit no-trade conditions. For example, gold crosses the same zone in both directions, the dollar and yields disagree, spread remains unusually wide, or the logical invalidation point is too far away for your risk limit. When those conditions appear, standing aside is not failure. You prepared for the branch, recognized it, and protected capital from a market that had not made a stable decision. Now turn the framework into a demo rehearsal. Open a demo chart before the release and create 3 simple scenario cards. Each card needs 4 lines. What the minutes might emphasize. What related markets should broadly show. What gold must do after the first move. And what invalidates the idea. For the hawkish card, write the evidence required for the branch to remain coherent. For the less hawkish card, do the same. For the mixed card, write the exact conditions that tell you to stop interpreting every candle. Next, choose a small fixed percentage of the demo balance as your maximum planned risk. The exact number matters less than consistency and suitability for your own plan. Define the stop from invalidation, not from the amount of profit you hope to make. Then calculate position size from that distance. During the release, your first task is observation. Record the initial direction, the dollar, yields, spread and whether gold holds or rejects the chosen zone. If no branch has enough evidence, take no demo trade. A blank trade log with clear observations is more valuable than a random entry followed by a lucky result. After the event, review the process rather than only the outcome. Did you follow the prepared branch? Did you enter while spread was unstable? Did you move the invalidation point after price approached it? Did you confuse a profitable trade with a well-executed trade? Demo practice cannot reproduce every emotional and execution difference of live trading. Its value is repetition. You can test whether the framework is clear before real money adds pressure. Here is the complete plan. Prepare 3 branches, more hawkish, less hawkish and mixed. Observe the dollar, yields, gold structure and execution cost. Wait for price to hold or reject a meaningful area. Define invalidation before position size. And allow the mixed branch to end with no trade. The goal is not to guess the Fed faster than everyone else. The goal is to enter the event with fewer decisions left to improvise. If you want to rehearse this framework without risking real funds, you can find the demo or account link in the description or pinned comment. Build the 3 cards, test the process, and judge your execution before you judge the result.